We will give another 2 minutes and we'll start. Today, first we are going to do the other test paper what Mr. Kaling has shared with you. That was the latest one, 7th November 2021, and thereafter the second session I am going to devote uh, on revision. Revision, we will touch upon the important slides and do explanation. Those are not the ones which are going to be not necessarily to be the question papers are said this time, but more or less you need to study those in order to answer the question paper, which I have not set yet. So still let me share the slides with you, then thereafter think of the questions. Right. Once again, good morning to everybody. And first we'll take that question paper. You all see this on the screen?
Yes, sir.
Right. So it says Institute Bank of Sri Lanka, Postgraduate Executive Diploma in Bank Management. Risk Management is the subject. Date is 7th November. Time allowed 3 hours. There are 8 questions. You need to answer 5. Each carry 20 marks. Silent, non-programmable calculators are allowed. So we'll take the first question. It is COVID-19 pandemic has changed the risk profiles of financial institutions. I think we all agree that after the pandemic erupted, you all get busy in different ways. Different targets have been given, mainly because the risk profile in the bank has changed. Now, explain how the integrated risk management framework. Now, when you say risk profile, is the keyword here. Now, financial institutions are we all working for. So, risk profile is the type of risk affecting your business. So that you must immediately remember type of risk which encounter hardships of banks. I originally said financial risk, operational risk, strategic risk, and regulatory risk. Then we had some subsections also under financial risk. We looked at credit market and liquidity. Then under operations, we looked at legal, reputation, and technology. Then we had the regulatory risk and the strategic risk. So if you can remember that those 3 circle diagram, and if you put that, then I know that you have understood the first questions, what is risk profile is. Explain how integrated risk management framework established in the banks. Now, based on that risk profile, the next phase of your question says about integrated risk management framework. Now, if you can remember, I said integrated risk management framework was a result of the CBSL direction number 7 of 2011, that all banks should manage their risk under framework. Now, this framework means you should know what are the things included in this frame. I said policies, procedure, and the structure. So immediately you should get into your mind, moment the framework comes, it is about the policies. Policies are numerous, from credit risk management to market risk management, liquidity. There are different policies uh, which have been recommended by the management and approved by the board of directors. So we go to next one. Will enable them to mitigate all types of risk and the role of board directors in the risk management process. Now, role of board of directors is actually to see that what is the items in the risk management framework need to be approved by the board of directors, and also they will establish a subcommittee from the board of directors called integrated uh, board integrated risk management committee, which will also meet to assess the risk of the bank. So if you can answer that way, I'll be very happy. But you can go on. When I say framework, it's not only policies. The procedures are manuals, but bank has established, like lending guidelines, operational risk, operational procedure manual, then credit procedure manual. All that are uh, methodologies what we used in banks to educate and inform the people who manage risk to have their internal controls established, and also their limits. Limits are actually word in risk management is called risk appetite, and these limits have also been set by the board of directors. Then the third part under the framework is the structure. If you can draw the structure which I recommended, that is three lines of defense. You remember the first line of defense is in the management, where I told they are the risk owners, and mainly people who are in business are the risk owners, because then they have to um, work according to the guidelines given. And then you get the risk management team who give who identify risk, who measure, respond, and also take part in monitoring of risk. Then we have internal and external auditors. They give the risk assurance. So if you can draw the third part, that diagram which we remember as our structure of banks, recommended structure for banks, then you have covered these questions. Finally, the board of directors' role is actually the structures are determined by the board. Then the uh, what you call limits, which is risk appetite, also determined by the board. And then also all the policies and procedure manuals also been recommended to the board and should have the board approval for those policies. That way, board of directors get involved, and they also have a subcommittee called Board Integrated Risk Management Subcommittee to meet the businessmen, business people on the management level, um, along with the chief risk officer, on a quarterly basis to assess the risk profile of the bank. So if you can include what I said now, I think you can earn that 20 marks. So structure your uh, answer in a manner that that will please the examiner. When you say risk profile, you need to actually, here they say types of risk. So if you do the diagram and says uh, financial institution face um, four types of risk, mainly financial risk, operational risk, strategic risk, and regulatory risk. And then you can also, if you want to do extension saying that the financial risk include credit market and liquidity, and operational risk include reputation, legal, and technology. Uh, then you can say the confidence of financial institutions remain as long as they adhere to the regulations, guidelines given by the regulator, which is Central Bank Sri Lanka, which is called compliance risk. And so if you identify, then you have to mention uh, integrated risk management framework, was introduced under the direction of Central Bank, Direction number 7 of 2011. There they requested the banks to have policies, procedures, and structures established. So if you can give example, the structure and the few items of policies and few items of procedure, then you will say these policies, procedures, structures along with the limits are being referred to board of directors and for their approval. And once that is the role what the board of directors play. Apart from that, they have a subcommittee to monitor the risk profile of the bank. So if you write that, uh, you can earn that 20 marks. Any difficulties or any further explanation you need, can have some inputs. Is it difficult or very easy?
The evaluation of stress testing should
Yes.
be uh,
Yeah. You also, if you can have further extension to this, you can say doing this, they follow the process of risk management. Risk management process include identification, measurement, uh, responding, monitor, control, and report. Under identification, you can say they also can use stress testing as a way of identifying the risk of the financial institution. Got my point? Can we go to the second question? Okay, right. Second question is, in the monetary terms, loans and advances of the bank financial position statement remain substantial exposure to credit risk. Now, this statement is, you know how we derive. You can remember the balance sheet which I gave you, the 100 billion balance sheet, current assets plus fixed assets equal current liabilities plus long-term liabilities plus equity. Then I went on to describe further items which is coming under current assets, cash, investments, and loans and advances. So this question is talking about loans and advances. So it says in the terms of your financial statement, that is your balance sheet, the largest exposure is credit risk. Naturally, because we identified a sum of 69 billion out of 100 billion as loans and advances. So if your bank's credit exposure is 1 billion and 90% of which is given as business loans. So if you have 1 billion as loans and advances and the 90% of which is given as business loan, work out an ideal concentration to different industry sectors specified by the regulator. Now, I had a, you know, that this is related to credit risk. Credit risk, I mentioned, there are two types. One is a counterparty risk, the other one is a concentration risk. So here they are talking about concentration. Concentration to industry sector. So they have actually looked at the entire credit portfolio, um, which is also there's a statement to say which is the largest exposure in terms of money, because that's the largest amount which have been given under credit. Then on that, when we are talking about concentration, concentration is here they talk about industry. So regulator gives a pie chart to us. What are the type of industries funds can be lent to. So they start with agriculture, and since Sri Lanka is a agricultural country, most of the GDP growth come from there. So central bank wish to have a limit or regulatory limit for banks. They say minimum of 10% of your total advances should be given to agriculture. So if you have 1 billion in that, at least 100 million should be given to uh, agriculture sector. So the first sector you have already has a regulatory requirement has to be met. Rest of the sectors, it's a bank's risk appetite is the important thing, because where to which sectors bank wish to lend will be decided by the risk appetite of the bank, which generally when you prepare the budget, you draw this pie chart. Now, let me tell you what are the industry sectors generally bank. If I can remember everyone, I think I also need input from you because I'm not looking at a actual pie chart on that slide. But I can remember it's agriculture, construction, then you have trade, you have tourism, you have transport, you have manufacturing, you have new economy, then you have financial institutions, um, then you have others. Others under that you have retail credit given to customers, inclusive of credit card. So I think I got it right. You can refer the slides again. The sectors which I mentioned. Generally, we actually looked at this at the time of preparation of our budget. So now if the bank's current exposure is 1 billion, and next year if you are going to plan a 20% growth, next year 1.2 billion you need to allocate among the industry sectors which I already mentioned: agriculture, manufacturing, transport, tourism, trade. Accordingly, that so you have to take this 1 billion and show the current level, and then on the same diagram there is a slide for this which I have already uh, shared with you earlier. Then you will say the budget is 20%, and then you need to allocate 1.2 billion among these industries. Now, if what I'm trying to get from you, um, the regulator demands 10% for agriculture. So that even the bank cannot change. The balance will be based on risk appetite for different businesses. The board of directors think are more suitable for us to get engaged and give credit. So if that all depends on the performance of the industry. Now you know very well in Sri Lanka after COVID-19, tourism sector, transport sector, and the construction sector all are affected due to various reasons. Non-arrival of tourists, uh, because of COVID, even the local tourists cannot visit hotels and go to places of attraction where government will earn, banks will earn money. So as a result, these three industries which I mentioned, I know most of the other industries also get affected, but these three industries are directly affected by the COVID-19. So if next year, if things are not going to be rosy, or if economy is not going to recover, you will need to be very cautious in lending money to these industry sectors. So your next year budget, either you will keep these three sectors in the same level what you had this year, uh, or on a reduced basis, you will approve the allocation for each industry. So when you allocate that 1.2 billion, you can have another column in the same uh, box or the table, and you say why it is been recommended. So if you have allocated tourism 10 billion this year, and next year, say 100 million this year, next year, if you want to curtail that to 80 million, then there will be reduction. So you write as a remark, why reduction? You can say due to pandemic, we expect the tourism sector to be uh, stagnated, and there will be a downturn in business related to tourism. As a result, uh, we have reduced the allocation for this particular sector. Similarly, if you increase to trade, you can say we are now canvassing new customers for who are engaged in exports, and new kind of trade transaction take place on the digital platforms. To support that, we have allocated more money for trade as well as new economy. So if those increases are given to those new economy, you can put that reason. So that's how you should answer this. In one table, you can answer this, but I prefer the recommendations. You need to little bit elaborate to get me an idea why you put that amount under that ideal concentration to that different industry. Um, I will show this when we are doing our revisions also, because then I'm going to get all the slides and run through that. Then I will somewhere there I will stop on this, because this is about credit concentration. Now, credit risk can occur due to customers defaulting, that is counterparty risk, and then banks' inability to allocate correct percentages for right industries also could result in higher NPA due to failure of those industries. So that's the answer which I expect from this. Any comments? By this time, you must also uh, speak to me. Then I can give more inputs that may be useful. If you don't provoke me with your suggestions, uh, I think that you have all understood, and that's it. Then I'll move on to the third questions. Once again, I'll ask anyone who has any query. Language is not a problem. You can speak to me in singular. Also, I can answer. Right. So I think now you'll know the first two questions, that is risk types, the IRN framework, then what is the board of directors responsibility. Then you know that we have two types of credit risk. One is counterparty, the other one is concentration. Concentration need to be managed with limits approved by the board of directors. So allocation has to be recommended by the management based on industry performance, and board of directors will determine whether those allocations are right. So both these questions, the board of directors approval is required to go ahead. That's why we said board of directors are directly responsible for risk management in the banks. Now, third question is also credit. It's a very straightforward question. explain the credit process adapted by uh, your bank's credit department and how the process enables the bank to mitigate counterparty risk. Now here, originally we tried the other is called concentration. Here they are talking about a credit process. Um, Now credit procedure manual actually describe uh, to whom we should give, uh, how do you manage your documents, what's the process you need to follow in evaluating a customer, so on. But I drew up one slide I can remember. It has two sides. I also said the process is two sides of a single coin. And one slide, on one side, I put credit management. The other side, I put credit risk management. So where counterparty risk is concerned, these both are required to, act simultaneously in evaluation and approving credit facilities to customers. For this reason, you need to actually draw that process chart, which I originally shown you. I will touch at the time of revision also this particular one. It says on the management side, the customer comes in, then I have put loan origination. That's where, all the documents related to customers being collected. So loan origination is actually information gathering exercise because those information are to be evaluated to determine whether the customer is creditworthy. So information you have to get not uh, uh, you know some, but you need to get the total required information to evaluate a good credit proposal. So that's why on a corporate customer we ask for 3 years balance sheets, profit and loss account. Then we ask management account, age and list of debtors, stock statement. Those are all financial related information. And then we ask your company's profile, what kind of product they do, what profile will indicate who are the directors. So all that what we require this is to evaluate a customer. Now on the credit management side, next item after loan origination is the evaluation. Now evaluation, we also categorize this into two parts. One is we say financial evaluation, or we say quantitative evaluation. The other part we call it qualitative evaluation. Now, quantitative evaluation, we on a corporate customer, we went to see profitability, liquidity, um, then we say solvency and the efficiency. All that we checked under financial evaluation to determine the creditworthiness of this customer. Then when it comes to retail customers, I mentioned that you can apply credit scoring method, or you can apply the 5 C's of good credit. Then SME customers, I mentioned that since you cannot rely on financials, you need to structure their financials by um, knowing your customer, the management of your customer versus the industry. Then we said the company versus the industry, the management skill versus I mentioned few items under which you can use your SME evaluation. So what we do mainly, we do a financial evaluation and a qualitative. Qualitative evaluation include, marketability of products, director's reputation, the borrowers, where you can't measure with figures. Rest is being looked at under qualitative evaluation. So once these two are done, I also said then they prepare a credit appraisal form. Now, after you doing the evaluation, you prepare a form for approval. Either we call it a credit proposal form or credit appraisal form. One copy of this will be sent to risk management unit. So they will also see the evaluation what you have done under financial risk and also um, qualitative risk. Apart from that, the credit management side nowadays do a credit rating of this customer. It's a very important to understand because um, in order to measure the creditworthiness, apart from the traditional methods we follow, it's better to have a system system control mechanism that will help us to identify the creditworthiness of this customer. As a result, most of the banks have um, this internal rating model. So all those figures and the qualitative aspects can be input into a system and get a score under this rating system. If that score is, I told, if it is very high, like 90 to 100, the system will say this customer is a triple A customer. From 80 to 90, you will say double A customer. 70 to 80, a single A customer. Then 60 to 70, you say triple B. Then 50 to 60, we'll say double B. Now below that, below 50 marks, either it will be B, then C, single B and C. Those I said, those are not actually considered for credit facility because we call them non-investment categories under the credit rating. So we may not invest our money on those customers whom our own credit rating says they are not creditworthy. So in evaluation, this rating module also very vital for you to understand. Rating model is being prepared based on certain parameters. Now I'll tell you one parameter. One parameter is, we say a corporate client. You are looking at his liquidity, or we'll take solvency. Solvency is measured by way of debt to equity ratio. That means how much money this customer has borrowed against the how much money capital he has infused to do this business. Generally, banks would like to lend maximum of 75% and request customer to uh, input his own contribution. So if his own contribution is say 25%, we can allocate certain marks. If customer was 50 and a bank's 50, that would be very ideal. So he has a big stake. On a situation of that nature, you can allocate 100 marks. So one-to-one debt equity will enable to reduce your risk to the maximum. So therefore, on that parameter under solvency, if the results of your credit rating model gives one of debt equals to one of equity, that means 50% has been provided by the customer, 50% by the bank, would be a very ideal situation, and then you can give 100 marks. But we also accept customers who bring 25% and bank gives 75%. So those customers, we can give 50 marks. So this particular customer, if the debt equity ratio is 3:1, he get 50 marks. So these are, we call parameters in deciding the financial evaluation. The parameter is the solvency. The solvency is decided by debt equity ratio. And the debt equity ratio, we can have three sets of parameters like, 1:1 debt equity, 3:1 debt equity. Then we say no equity by the customer. Then, we are at a huge risk. We can say we will not accept that situation and we give 0 marks under that. So when the customer gets 0 marks in many of our evaluation points, he may not be eligible to creditworthiness. He may fall into a non-investment category like C because final score of is going to be less than 50. If a customer brings 50-50 and he gets 100 marks, these sort of customers with the rest of the um validation points also give him highest marks, he will fall into 90 to 100% level, then we give him triple A. So internal rating also need to be done by credit management. So apart from the evaluation, what you do for financial evaluation, um, qualitative evaluation, then the system-based credit ratings also need to be applied on customers, and those results also need to be shared with the other side of the coin stands the risk management team. So you send your results of um, your internal rating, your financial evaluation, your qualitative evaluation in a form called credit appraisal form to your risk management. So they also go through how you have got these results, and they also do the evaluation. Apart from that, they will see this particular proposal is in line with the procedure manual approved by the board of directors. Whether you have followed collecting the correct documents, all that, and also it will also follow and see um, based on the rating of this customer, we may have to allocate capital to fund this facility. That capital will not erode capital adequacy level. So we call it capital management. Or we'll look at the risk weightness of this particular proposal. If risk weightness is less than 100%, then we are good enough because then we don't have to allocate much capital in lending to a customer. But if this facility is given complete clean to a non-investment category, it also stands as a risk. Plus, our risk weight is going to go high, and as a result, we may have to allocate more capital. Then also you looked at whether these facilities are within the regulatory requirement. Is it maybe within the single borrow limit, or is it for a related party? If it is for a related party, have we followed the corporate governance rules? All will be checked by the risk management team. So then they will also prepare a form addendum to the risk management, the appraisal form. They will point by point will point out how the evaluation is being done. Finally, they will say the risk is high or risk is moderate or risk is less riskier, and then they will do the recommendation. So that is the process. Once that recommendation comes, then almost it's look like a joint approval. Then finally what we do is we disperse the facility, take in the specified securities. Thereafter you report. Thereafter actually you monitor, control, and if something goes wrong with the facility, you report to the management. So that is what the process is. This process is given exactly in one slide, but that slide need to be elaborated by the way I spoke to you, and then you build up your answer. With that, you should be able to answer this third question, which is a very direct question, and most of them actually scored high marks on this because they remember the credit process slides, and then they started deliberating on that. Any queries on that? This is also kind of, getting ready for your question paper. So I'm happy if you can understood well, and then you will find it easy to answer the final paper if you can understand this well. As I said, you need to read this and identify on which slide I have made this question. If you can remember the slide, and you can draw up that on the same way on your answer, and then you do a description, you tend to get the full marks. Right. Since no queries on that, I believe that I have been overly explained on this. So we'll move on to capital adequacy. The fourth question is on capital adequacy. Capital adequacy and liquidity risks are two important risk measurements of the bank's stability. Explain how Basel III framework and required ratio submissions to the regulator enable bank to adhere to compliances recommended by the accord. Now, this is also a very straightforward question. It is about Basel III. Now, Basel III, if you can remember when we discussed Basel III, we talk about quality and quantum of capital, we said, to increase to 14% on systemic important banks. Now, this is the capital adequacy part of it, because currently financial institutions are required to maintain 12% capital adequacy. That means your equity should be equal to 20% of your total risk-weighted assets. Risk-weighted assets are determined by credit risk, market risk, and operation risk. So if you take the risk weights based on the criteria given under Basel II, then you arrived at your capital adequacy. But moving on to Basel III, they started qualifying the assets, qualifying the risk weightness of each assets of the bank. And so they say some of the assets falling into, in your balance sheet, are falling into tier 1, some are falling into tier 2. And tier 1, your equity is mainly your shareholders' funds and the reserves you build up over a period of the profits you make. Tier 2 capital may include, like debentures, various other instruments where you have used to take money on a long term from investors, are sometimes falling into revaluation reserves. So a few items in your equity fall into tier 2 capital. But tier 1 is actually directly involved in your shareholders' money. So that is the core capital of the bank. So what the Basel III recommends is, what we need is money coming from your shareholders, or money build up by way of reserves, by way of profit and loss, which also belongs to your shareholders. So as a result, we compute under Basel II the 12% capital adequacy. Now that this get enhanced to 14%. So that I have given how the migration took place. There is a capital buffer, and tier 1 capital from 4% to increase to 6.5, which is the main contributor for that increase in capital adequacy. Capital adequacy actually it was at 10. You need to actually enhance to 14%. So 2.5 comes from the direct enhancement of tier 1, and then based on the risk your bank take, central bank will recommend a further 1.5 called a capital buffer. So that makes 4% increase. So under Basel III in 2019, I think all the banks were asked to adhere to Basel III requirements and increase their capital accordingly. And therefore, all the banks took the steps and then they enhanced their capital adequacy to 14% by way of right issues to their shareholders, retaining some of the profits they made during those years. Uh, Given the run up to the Basel III adherence, they started, getting research done in ready make themselves adhere to the this Basel II requirement under capital adequacy. So mainly where capital adequacy is concerned, it is quality and quantum of equity what is being considered along with the increase in quantity by into 14%. Now Basel II also gave us two other very important liquidity risk management measures. Uh, it introduced something called liquidity cover ratio and net stable funding ratio. So you need to actually mention these two ratios, the equation you need to give. Um, I think the liquid cover ratio is your high quality liquid assets uh, divided by um, 30-day net uh, outflow of cash within 30 days. If you have enough liquid assets, and this ratio should be more than 100 or more than that to make comply with this liquidity cover ratio. So it's actually you take your quantum of high quality liquid assets. I think we discussed what are the high quality liquid assets in that paper. You can go to the extension of even giving that. Cash is one of them, and then you divide that your expected net cash flow out in a horizon. We also call it time limit called 30-day calendar. And if you have the results, when you divide that, either you get 100 or more. That means your high quality liquid assets are higher than the requirement of cash outflow for 30 days, then your bank is sound. So you have covered your liquid coverage ratios been adhered to. Similarly, there's another ratio called net stable funding ratio. In banks, we also have different type of deposits. The funds to the bank come from your depositors. They put money on current account, savings account, and term deposits. So we put these into different buckets to see uh, under each period how much assets and liabilities we have. This is done by your assets liability committee to see whether sufficient liquidity is maintained at every duration so that we may not run into problems of liquidity. So under Basel III, they also identified there's certain amount of funds are required and it is available under stable funds. Now say from current accounts with your experience, it is repayable on demand. Customers can withdraw anytime what they like. But with the banker's experience, they know that this much of total current account credits, average, you can say these credit balances are there on average on a given date. If you monitor this for last 3 years, if you have a say credit balance of 20 billion in your bank, you can easily say average 10 billion will be not withdrawn by the customers. So The lowest level we have gone is 10 billion, and then even highest level of 30 billion sometimes that's achieved. So you take the lowest level and see those are your stable fund under current. Similarly, savings, you adapt that, then you adapt the fixed deposits because fixed deposits are exactly the term. And what we do is these stable funds are required to fund your advances portfolio. That's how you keep your liquidity going. So net stable funding is a keyword what we use. So if you can have required net stable funding against the available uh, uh, net stable funding. So if your available is we'll say 130 billion, and your requirement is 100 billion, so you divide 130 by 100, then you arrive at 130%. So net stable funding limit also, you need to have more than 100%. To have the bank's liquidity ratio of net stable funding under the Basel III maintained, it's a regulatory requirement. So liquidity cover ratio and net stable funding ratio, if you can describe, and originally the capital adequacy also can be described going into 14% quantum and quality increase, then you are through with this question. I remember I put this in two slides. One is for liquidity, one is for capital. So we will take those two slides for further study when we do our revision. Because this is an important area because now most of the banks need to adhere to this new capital and liquidity requirement and report to central bank on a regular basis to see that the bank's soundness or the management of risk under uh, the framework, because capital adequacy covers credit market and liquidity. But apart from that, they are worried about liquidity more in the Basel III. They introduced these two new ratios for bank to adhere to. So that is Basel III. And now we have already answered 4 questions. 80 marks have been scored. Isn't it easy, these papers? Anyone who thinks difficult? Right. I'll move on to right. Okay. Let me move on to the question number. You can see that the paper, because I moved out of that. Can anyone unmute and tell me whether the paper is visible?
Yes, sir.
Right. Okay. Um, but I think I did something and I cannot move on the screen. Right. Okay. Let me bring back. Right. You can see that, no? Yeah. Uh, Now we are going to the question number 5. As Chief Risk Officer of your bank, the Board of Directors have requested you to submit a board paper identifying the material key operational risk indicators. You are required to prepare a board paper including process you adapt to identify, measure, mitigate such key operational risks. Now, this is regarding operational risk. So the question actually tend to cover kind of an entire syllabus of operational risk. But the answers, what they say is, submit a board paper. You need when submit a board paper, board of directors doesn't want essays. Board of directors want clear, ideally one-page paper for them to examine their requirement. So here what the answer they're asking is a board paper. They want you to actually clearly indicate the key operational risk indicators. KORI is the question. So you can list out key operational risk indicators. Now, operation risk, there are so many key risk indicators you can submit to give your requirement of the operation risk exposures to your board. I mentioned quite a few when we did this. We'll take one. The operational losses due to cash shortages. So you can write if that's a frequently occurring loss. But now actually since we have covered with the tellers are responsible, and then you can list out and say these are the number of cases of cash shortages throughout the bank in different branches for the month, and the amount involved is so much. Then they are also asking what mitigation process you have adapted to minimize or mitigate this operational risk. So key operational risk is cash shortages due to errors made by your tellers. So as a result, a certain amount of time is being wasted to find this, reporting, though the tellers are subject to pay them finally, but yet we know that kind of operation risk is a kind of operation risk which is occurring very frequently, though the impact is low, but it's a kind of operation risk indicator. So you put the indicator and you will say the indicator should allow number of incidents and the amount involved in the particular month. Then you write what the actions you have taken. You can say you have enhanced your controls. That means tellers are being advised not to exchange money between them without a kind of a voucher. Then if you exchange money with a customer, to have a note on that. Even if you give change to a customer, make a note on that to see whether you have made an error on that. Then you also can say some CCTV cameras have been focused on tellers to see whether these errors could be rectified earlier, easier because of looking at the recording. So those you can indicate. So one I gave you, then from cash to I will go to clearing department. Clearing department, you will have this our bank customers issue checks to their business partners, and those ones check present. Our guys will not have money in the account as results. We return them checks. So this returning checks will be actually kind of a reputational risk to the bank, because if you have larger number of check returns being recorded, uh, people lose faith in the bank to accept our check. So then you indicate this indicator as a key operation risk indicator. You will say number of checks being done to the value of so much again for the month. Then you write what kind of, how do, here they're asking identify, measure and mitigate. So there are three things you need. How do you identify this? You have the complete record of, returns on a journal, or your clearing department should be able to give this figure very easily. So measure is, you need to see from customer surveys whether they have identified this, they cannot accept your particular bank's check because of, number of check returns are high. So those things are kind of measurement you do, and then you have to mention about the mitigation. Then you can say um, current accounts are being opened strictly to, after investigating those customers, uh, know how to operate a current account, and with clear instructions from the bank. So you actually do a survey or get a good introduction from your existing customer before you open a current account, or you increase your check return charges so that your own customers will adhere to issue checks only having balances in the bank. So you can write that as the measure or the mitigation technique what you have um, put forward to uh, get this operation risk indicator lower. Operation risk indicators, the higher the value, you do this in comparison to a quarter by quarter, and to see whether operation risk are rising. If risk are rising, then what happened is it is not good for the bank. Then you need to actually enhance your control measures, and you need to educate your staff, train your staff, various things you need to do to get this operation risk indicator. There are a few other operational indicators like staff turnover. Um, you also can say number of skim cards. Now say skimming is before we introduce this chip on a credit card, people duplicate cards of customers through getting magnetic records from a card operation, and then they recreate similar card and draw money. When that happens, since the customer has not withdrawn, then the bank is liable to pay, and those are become actually direct losses to the bank. So skimming of credit card is a major loss, operation loss indicator, which you can compare. So one of the risk mitigation techniques we have done in the past is actually to introduce this chip-based cards. Similarly, there are other things, staff turnover. Um, you can see most of the things what we have discussed when we looked at the operational risk. Operation risk, we also said, like, your cash in transport. I also mentioned that operational risk occur due to people, processes and systems, and also internal and external events. Now, looking at external events, you can say uh, robberies took place while cash being transported. Those are actually very high impact events, and the high impacted, low frequency events generally we mitigate through sharing the risk, or we take an insurance policy to cover that. So you can mention key operation risk indicator as a robberies of um, cash in transit, and you can give that indicator and say the mitigation technique is we have fully insured the amounts what we generally transport under cash in transit. So just give one table and give the indicator. Indicator you need to give values. Then you need to give, I prefer if you can give values of 2 quarters, and then you can, in the other column, you can use the mitigation techniques what we have adapted to, control this operation risk. Any questions? We
Excuse me, sir. How to measure that a particular indicator?
how to
Measure.
measure, right? Measurement is you give value to it. So that's what we do. Actually, measuring can be done through certain exercises. We also looked at a thing called RCSA exercise. That is risk control and self-assessment. So if you go to your clearing department and ask them to, fill this self-assessment report, they will give you the indicators of how many checks returned to the which value. So measuring is already been done when your indicator is being published. So only you need to, indicate the mitigation technique, but they have adapted or provide new recommendations to, mitigate such risks. Did you understand more?
Yes, sir.
Right. All right. So we have covered 5 questions. You are asked to only provide 5 questions, but for your information, we'll go on to the rest of other 3 also. Number 6 is based on information risk management. Electronic delivery channels are now being used to its maximum by the banks to provide customer convenience during current difficulties faced by them due to health hazards. Actually, online banking, online shopping, the e-commerce are very much in use now because of similarly banks now deliver their services through electronic. You can order your um, balance inquiry, you can order your statement, you can order your checkbook through. You don't have to actually visit the branch to do all this because of these delivery channels available to you. And also you can do fund transfers. You can check the rates the banks offer on fixed deposits plus exchange rates but they quote. So it has become very easy if you are connected to the bank through an electronic channel. So most of us now have this online banking or internet banking to facilitate that. So it says as a result, banks are faced with enhanced information risk. I told you, good old days, we operate branch banking, we call it brick and mortar. So the opening hours are from 9 to 1:30. So risk of outside interference or the outside events affecting operation risk is during that business hours only. But when you have electronic delivery channels, your bank is open 24 hours, 7 days a week, 364 days in a year. So you are fully exposed. So explain what is information security and cyber security measures adapted to banks to manage information risk. Information security and cyber security are 2 different things. Information security is actually covering the whole gamut of things, like your entire computer system, the hardware, software you have adapted in all your systems, uh, the securities what you have provided is covered under the information security. Cyber security is mainly uh, security, what you have, security measures, what you have uh, introduced or adapted to safeguard your database from hackers. So mainly the firewalls, new techniques, what you adapt, monitor these cyber attacks are come under cyber security. So information risk can be mitigated by various things. You should not allow unauthorized people to enter your uh, main computer frame is placed in an office called data center, and only the authorized persons are allowed to go in there. Then they also need to ensure that all the hardware and software what they have purchased being insured. So if something happens, that you will be compensated by sharing that risk with an insurance company. Then also various other things. Also you have this password control. So you will educate your customers and give them a password, and these passwords are generally valid for a period, and then you give the option to change by themselves, and that education also part of a measure adapted by bank to reduce. Then they also will introduce that to be alert on emails, and emails that can use to attack your database. Then most of the banks won't allow you to use your flash drives, pen drives on your system, because those can introduce certain viruses to the system which can spread to the entire system. Then the failures of the system also been measured of by way of computer downtime. And if this computer downtime is occurring frequently, uh, the measure is available is to to switch on to your data data recovery center, disaster recovery center. There's another computer frame which you can operate by just a switch of a button, and so this computer downtime exceeds certain time, so you are allowed to access the disaster recovery site mainframe and provide those information to the users. So there are so many we have discussed like this under information risk. So dual controls, password controls, access controls, those controls are really vital to provide information risk, uh, to manage information risk, because the risk could happen from fraudsters within the bank and outside the bank. So you need to make sure that only the authorized people have access to systems. Thereby, you prevent information risk, and also various methods of introducing up-to-date uh, data protection measures like firewalls will allow you to safeguard from cyber attacks, providing cyber security. These things are the ones which we explain under your information risk, and not like earlier ones. You may need to take two risk and mention the events that may occur uh, to on the information risk, and how do you propose to mitigate, and how do you have already introduced to mitigate such risk, not to have a lost position to the bank. So this is the answer which I expect. Am I clear? So you can see from the questions what you have tackled. The first one is based on the complete introduction or the IRM. Second one, we have tackled credit concentration risk. Third one, we have tackled again credit, is the counterparty risk. Then the fourth one is covering Basel III. Fifth one is about operational risk. Sixth one is on information risk. Now we'll see, go to the seventh one. It is based on market risk. You know, market risk is um, I also call them price risk because it is about interest rate, exchange rate, price of commodities, price of stocks and shares. So managing those fluctuations to the advantage of the bank is actually market risk management. So investment committee of your bank recommends to dispose and liquidate following investments or positions acquired during the year. If the profitability of your bank as at 31/10/2020 is 900 billion, state the impact on profitability if you execute the recommendations of investment committee during November 2020. Right. So we have some portfolios which investment committee is asking you to sell. Now, the first portfolio is equity portfolio. Equity portfolio is the shares. You have shares of 5 listed companies purchased at a cost of 250 million. Now, these include, mathematical or arithmetic calculation. That's why we allow you to have a calculator brought into the examination hall. So 250 million, current market price is 231. You have received a dividend to the value of 1 million during the year. Now you need to compute profit or loss of this particular transaction. Now already bank is in profit made out of, their interest incomes, net interest income and other charges what you have levied. So up to October, they have made 900 million. Now this particular transaction is going to take place in November, and if it is a profit, it will get adapted to the 900. If it is a loss, you may have to deduct from the 900 million you have already made. So you need to understand that arithmetic also. That's why these figures are given. So these 5 companies, 250 million, they have received 1 billion during the year as dividends. So you invest 250 and you sell at 231, you made a loss of 19 million, but you have received 1, so your loss is 18 million. Now here what you've done is, so your current profit is 900, you deduct 18. So based on if this transaction goes through, your profit will come down by 18 million. Now, if you are a very clever banker, I go a little further. Actually, I didn't expect to provide additional marks for this because I structured this question to give marks based on that particular calculation only. But, having invested 250 million, what happened? This 250 million has been invested in government securities for 1 year. Bank would have got some interest. Here we have lost interest also based on this investment. But if you are very clever, you can do an imaginary rate for your government security investment and you can add that to your loss because interest is being foregone due to this investment. You actually, investment committee expect you to do that, but for the simplicity of the answer, I was not expecting that. Not a single answer script had that. I was expecting some creative thinking of a participant to think as a professional banker, everything what we do for interest. Nothing we give free to our customers. You do a service, you charge a commission. Similarly, if you do an investment, you also need to calculate the interest foregone. So if someone has given, I would be very happy to receive such answer. But in this particular year, not a single person actually thought of that. And but I didn't penalize anyone not to be very creative. So the second one, so first one we have lost 18 million. So second one, commodity investment of 24 karat gold purchased at a cost of 200 million. Since then, the market price has appreciated by 10%. So now 200 million one you can sell with a markup of 10%. 10% is 20. So you will have a profit of 20 million from the second. So first one you have lost 18. The second one you have gained 20. Right? Third item what we have is bank has a short forex position of 2 million and booked at 186 per dollar in the balance sheet. However, the present rate is 109. The present rate is, of course, very much high, but this question paper said in November. Now it's about 203 official, and black market is enormous amount of markup of maybe 30, 40, 50 rupees coming to this. It's a real problem for the importers. So when you say short forex position, short means when you take the net open position of the bank, taking all the currencies converted to US dollar and arriving at the US dollar balance of all your Nostro account, Vostro accounts, all that, you have a short position. That means it's a debit balance of 2 million. So when you owe to other banks $2 million, um, and $2 million is a debit balance is being converted at the rate of 186. So you put the rupee value in your balance sheet because your profit is stated in rupees. So 186 into 2 is the current short position of your balance. But the present rate is 190. So 192 is the amount should appear in your balance sheet as a debit balance. So there's a 4 rupee difference. 4 rupee into 2 is 8 million. So 2 million. So 8 million, you have a foreign exchange loss because you are having a debit balance. So this add up to your total of other calculations. So the first instance, you have made 18 million loss. Second one, 20 million profit. Third one, you have 8 million loss. So when you add up these, 18 minus 20 is 2. You have 2 plus, then you deduct minus 8, you have minus 6. So finally, what I want the calculation is from your 900 million, 6 million will be deducted based on this transaction. So the final answer will be 894 million will be your profit after this particular 3 transactions take place. So it's a mathematical calculation and easy one, of course, to earn 20 marks. Clear? So market risk is generally involved. I told you it's a price risk. So the price risk, it's easy because prices has to be stated in rupees or in a foreign currency. And the difference is the shortfall is the risk what you have run. And as a risk, you have a loss. If the risk what you have run has gained you money, it will go into the profits. So these three examples which you have been put, two of your investment decisions uh, created losses, like having a share portfolio of 250 million in these five companies, and due to have a loss of 18 million. Similarly, you owe other banks $2 million. If you had $2 million placed in other banks, uh, your loss portion would have been reversed when rupee get depreciates, the exchange rate goes up, and now it is heavily being depreciated. And as a result, if banks can have uh, positive forex positions, long positions, that means not short positions, bank can make money. Foreign exchange profits will add up to your profit. So the commodity investment has made profits. Risk you took in, investing in 24 karat gold has given you the advantage of a different price occurring at a different level of time. And at this particular time where you decide to dispose, you have 10% appreciation. As a result, you have a 20 million profit. So it's very easy. And I find most of them answered this question. Uh, some got little upset over, this short position. Short position, they didn't understand what it was. So they calculated as a profit of 8 billion in the third transaction. And then their final maths didn't work out because 18 plus 2 plus 20 went there until this particular forex position. What they did was they add this 2 into this 8 rupee profit and show the answer as 10. And then they put the total as 910 profit at the end. And as a result, they got some marks due to not understanding what is short forex position. So you need to actually really understand the question well before you start putting your calculator into operation and do the calculations. Are you clear? Right. The last question before we take, then thereafter what we are going to do is actually revisions. Um, this itself actually a great revision. So my ability to tell you without even looking at papers also got improved by trying to answer all the questions. So let me try this one. Number 8 is regulators are concerned with strategies adapted by banks to overcome lower profits due to the economic downturn created by COVID-19. Now, banks would like to make profits, and you are there to, help to make the banks to make profit, because certain strategies get changed based on situations what we face. You may increase your commission, you may increase your service charges, you may, um, increase your interest rates on various asset products. You allow your depositors lower interest rates, thereby you increase your spreads. Um, Banks have this foreign exchange problem nowadays. Uh, some of the banks actually, there was a time actually the rupee was appreciating. When the rates were 186, sometimes it came down to 181. So when that occurs, your treasury thought rupee might stabilize further, and that time we had, of course, balance of payments 9 billion US dollars in our reserves in the country. And the reserves were doing well when the tourism and the foreign workers started remitting money. Uh, and the outside debt repayment also became very low in 1919, 2019. As a result, we managed to build up our reserves. When you have such a reserves, you are in a position to, your currency will get appreciated. That's the time the bankers will think better to have a short positions, better to borrow dollars and keep it. But things change very badly after the COVID-19. The foreign remittances didn't come through, tourism failed. So all that finally end up in huge currency shortage of foreign currency due to central bank being unable to pump in dollars to boost up the economy to support the importers. So as a result, now there's a huge demand for dollar and it has a huge crisis where uh, to whom they should allocate the available dollars. Dollars are required by importers. Dollars are required by foreign travel. Dollars are required to educate students who are abroad. Dollars are required to pay for medical expenses Sri Lankan Sikhs abroad. Uh, so those things are the services what banks provided for their clientele. Now they are, being their hands are tied. They may not be able to borrow money from central bank in case of shortage. So they need to manage with the reserves what they have. Um, if they don't have a long position in forex, if it is a short position, then they are much more in trouble because then you need to borrow more from your dollar supplies of you the banks and need to pay a higher rate plus higher interest rate on those borrowings. So as a result, some of the banks are facing a crisis where when it comes to um, market risk of foreign exchange non-availability of dollars in the market. I hope I uh, gave you answer for that. Mohan, okay? Right. Then the other last one is I told you about downturn due to downturn of COVID, downturn of economy affected by COVID-19. Profits of the banks fell. Now this is particularly evidence if you look at the share market where all the banks are listed, and you can see the shares which were traded, like Sampath Bank was traded something like 275. Now it is going at about 55. Then Ceylon Bank one time traded at 100. Now it's about 40s. Commercial Bank about 150. Now trading at 80. Um, so the share prices also have come down because uh, the investors expect banks to make lower profits in coming years because when economic downturn occurs, there are a lot of regulatory restrictions also came in uh, to have a moratorium on repayment of loans by the affected industries. So the interest income from those loans were not recorded in our P&L when there's a moratorium, and also most of them has to be rescheduled at a lower interest rates, reducing our profitability. Plus, just now I spoke about forex. When dollars are not available, you may not be able to issue letter of credit. Then your commission on letter of credits also will get diminished. Then you may not being able to, forecast forward rates and make money. So various activities were related to forex also got affected. Not only credit, the market risk factors also involving bank having to take the risk, but we are not getting the return as we expected on a type of economy now we are facing. So the bank supervision, but banks need to find strategies. Banks, one of the thing is bank would like to make profit. When the going get tough, they will also have tough strategies to, somehow make money. So the bank supervision department has requested the board of directors to review the functionality of board subcommittees, describe the current objectives and functionalities of 4 board subcommittees. So this is actually not only the economic downturn, they are also looking at how does these subcommittees, are they actually doing certain manipulations to make higher profit, or they are managing things to, not to run into loss situations, are important. Now you need to remember the 4 subcommittees. Board credit committee is one of the subcommittee. Uh, in those days, they didn't consider because we had internal credit committee in the banks, but most of the banks now they have both cred- credit committee as a subcommittee. Then we have board audit committee as a subcommittee. Then we have board nomination and remuneration as a subcommittee. The final committee is a board integrated risk management. So these committees, they have a terms of reference or the way they do things, what are the items they take in their committees, in their agenda, need to be remembered. Now, I'll take board nomination and remuneration. When there's a COVID-19 downturn, if you declare a high percentage of performance bonus to corporate management, what will happen? This has happened in some of the banks. That's what I put this question also. Based on the past profit, they have declared, despite downturn, the top key management personnel have enjoyed a high rate of bonus uh, for their personal benefit. Now this has been approved by the board nomination and remuneration committee. So this approval may require the review of functionalities of the board subcommittee. So similarly, we have integrated risk management committee. They may have to look at the overall picture of the banks, like complete risk profile of the bank to see where whether the risk appetite need to be adjusted, the policies to be amended, uh, organization charts to be changed, uh, and the procedure manuals need to be amended, is the functionality of this subcommittee. So if you mention some of the things under risk management, these, you will get the full marks. Then where board credit committee is concerned, when COVID-19 hit, certain industries are not doing well. So the credit department, credit board subcommittee will always be lookout whether how to reduce losses related to those industries. So new facilities being evaluated, being properly checked by this credit committee. Then also they will monitor loans under moratorium, how they can possibly put them back to into operation and start earning money. So board subcommittee. So when COVID-19 occurs, uh, audit also has to play a risk assurance role, because when pandemic occurs, when the economic downturn happens, the risk profile of the banks goes up, then they need to actually do inspection more to see whether the branches are following the laid down procedures, um, and so on. So those are the things what you need to actually mention as answers to this particular question. Any queries? Now I finished the 8 questions. Right, let me see. There was a yeah. There are 2 items in the chat. The one question I already answered to Mr. Mohan Guru Singh on the market risk. The other one is from Miniruan De Silva. So, is current car in the SIB? Uh, SIB, I believe, Savings and Investment Bank, or is 13% or 14%. It was relaxed by CBSL to 13% due to COVID. Thus, it brought back to 14 by them. No, I'm not very sure about this. Midruns simply a lot of regulations have been changed after this pandemic, including liquidity ratios and the capital adequacy ratio. So they have relaxed. SIB is a systemic important bank. Originally, it was 14%. If the CBSL has reduced to 13, probably they have, because of the pandemic, they gave a lot of regulatory requirements being relaxed. Even 21% liquid asset ratio was reduced by 1% to 20%. So if it is 13, I think that applies. You need to actually check with your finance department, whom they prepare the capital adequacy of the bank, and check whether CBSL has allowed that. Or you can go to the website of the CBSL and go to directions issued by them. Probably the answer can be get. All the directions what they have issued after COVID-19, I don't have actually a copy of that. I didn't check. So I'm sorry. Can you check? I think probably 13% may be right. Right. So we have gone with the 8 questions, and there are a few queries. I'm very happy that people come forward and ask questions. Um, this is the way we learn. Uh, you get the best out of me to answer things, and then also I know that you have understood the subject. So I'll be happy that in preparation of my next paper, I know what level I should target uh, in setting up the questions. So we will take a break now. So we have done 2 past papers, and actually these 2 past papers covers the entire syllabus. When you cover the entire syllabus and you do past papers and find answers, the answers which I gave you, you may have not noted down in a piece of paper, but try to elaborate and redo yourself. You have the question papers as a precursor to your exam. If you redo and read for yourself, or you can refer to one of your friends and see whether my answers are adequate. Unfortunately, I may not be in the country probably from 10 days from now for period, I don't know. So otherwise, I could have invited you to even submit this as a specimen answers, which will help me to prepare the next question paper. Um, but I will see that before I go, I will do the question paper. But this is the way to rehearse. Uh, I have done with you through online the answers, and you may have noted down the specific items, and then you put into a paper. What you are doing is actually you are sitting for a mock exam. When you do that, you have the 100% confidence to go to a final exam and score highest marks. And this kind of methodologies or techniques will help you to face exams. Right. We are taking a break, and I will start. It's about I need to get those entire slides. What I'm going to show you. Otherwise, presentation might take a little longer because switching from one subject to the other. Um, but we will try and cover as much as possible in our next, say 1.5 hours. We'll devote. Uh, we'll start at 11 and then we'll go on till 12:30 in your revision class. Thank you. Do you all see me or do you all hear me? Can someone respond? Am I on the screen?
Yes, sir.
Yes, you are.
Right. Now we are going to do a revision. Um, so I will take, what I will do is actually run through important slides. We have covered 2 exam papers. Some of these slides would have been the ideal answer script what you have to give. So I took some of the slides, and while going through, I will tell you what is the type of risk, and then on which slides generally, normally, or I'm going to prepare questions. So then your answers can be, made by studying those slides in particular, rather than having to, I have presented some 200 odd slides. So we have picked some of the slides which I consider as important, and then we'll do the revision on based on those slides. Before doing that, once again, there's a question from Nissan Sala asking what is the deadline for the assignment. So what was the deadline conveyed to you by Mr. Kaling is the question I have to answer, because when I spoke to him last time, he is planning to have the exam on the 20th, and then deadline for assignment is end of the month. I hope that has been conveyed to everybody. So keep those 2 dates, and you can verify from him if there's any changes, because I am also logging to them on remotely, and the arrangements what they made at the institute for your physical presence at the examination is vital. So they are the people who best know when the exam is going to take place based on the situation and the arrangements what they can make. Assignment, I was originally to plan before examination, then due to popular request, we extended till the end of the month. Okay, I hope you are happy with that. So we'll see how we get about with our revision. Did you see this slide? Can somebody
sir.
respond?
Yes, sir.
Yeah, types of risk. So this is actually the base for any introduction to risk management. And most of the first question on the paper, you need to understand this first. The type of risk the bank or any financial institution is going to encounter. So to simplify, I actually have these three circles, and in between there's a hub, which is called regulatory risk. Financial risk, strategic risk, and operation risk are the main items. Apart from that, being a bank which is being controlled and regulated by the Central Bank of Sri Lanka, so we call them regulator, uh, and they issue a lot of compliances for us to adhere. And so the compliance risk also come in between as one of the major risks, because we need to adhere to their directions, banking laws, and various acts what they have published in the or passed in the parliament. So you need to understand financial risk has three other subcategories called credit market liquidity. Operation risk also will have three sub categories called legal, reputational, and uh, technological. Then strategic risk is to do with customers and your competitors. Um, so managing all this is important for us to move forward. And they also say you also need to understand the process involved in risk management. It's identifying, measuring, responding, monitoring, controlling, and reporting. So types of risk need to manage the credit, operational, market, and liquidity, regulatory compliance, reputational, legal, and so on. Then they also talk about central bank direction on this risk management, direction number 7 of 2011. Then they want us to, manage the risk in the bank on an integrated manner. That is to have policies, methodology, and the structures which need to be approved by the board of directors. Then this is not to consider as a back office function. Main bank's profitability, capital adequacy, all will be subject to, if you don't manage risk, they get affected. So it has to be considered as a value creation to the shareholder, like what you do in the business line. So these two slides are important slides which I consider to give you a kind of an introduction, and some of these slides need to be understand. The terminology, the process, uh, the integrated risk management network, and also policies, methodology, structure, and the risk appetite we talk about, setting limits on various aspects. So these are the things what we need to understand in our introduction of integrated. If I have to give you exactly what integrated risk management is the process. Process, identify, measuring, responding. Apart from that, you have this board of directors, and the rest of the people who are in the bank are also responsible. I mentioned to you that three lines of defense. So everyone is involved, but board of directors involved in oversight or this kind of a supervision or approving certain recommendation made by the management of the bank. So this is the another slide important, and then the structure. And you need to remember that under integrated risk management, policies, procedures, and structure play a key role. And structure, we have a diagram of this nature where we have risk ownership, risk control, and risk assurance, coming from business lines to risk management department, and from audit. So these three lines of defense will be the safeguard, are to safeguard the bank's interest in the sphere of risk management whilst achieving profits for their shareholders. So it's another important slide which I think if you can remember, because it's a value creation slide. Then if you know those three or four slides, I think you should be able to answer the first question very easily, because you know the type of risk, you know the integrated risk management, policies, procedure, and structures, and then um, you need to adapt that to a current situation. How these things could be useful in safeguarding the bank's interest when it comes to risk management. So with that, I think you should be able to answer the first question. So I thought I will only provide slides to match 8 questions so that you will be, I know bankers are busy. Uh, Finally, you can summarize into your total slides what you need to study, and then you are ready with those summarized form with good understanding to face the exam. Next item is based on credit risk management, and you remember we tackled in our exam test papers, past papers. We said some of the questions come from counterparty risk, some of the questions come from concentration risk. So credit risk is classified under counterparty risk, that is to risk involved in default by the customers, and then concentration is due to failure in industry sectors, failure in products. Those are actually the failure of the bank staff to safeguard their portfolio. So concentration of risk occurs, trying to put all the eggs in one basket. Therefore, both counterparty and concentration risk management is necessary for you to manage your credit risk. We had a question on this, you remember, in the last paper. We asked you to actually do the risk credit process. Now, if you could remember the both sides, credit management and the credit risk management well, through this slide, you should have answered that question very easily. You know the process involved, customer coming in, and then the credit origination, where I said you need to take all the required information, the forms or facilities, whatever they ask, the financial data, the qualitative data, all that need to be collected at this point and then put on to credit evaluation. And then we talked about a credit appraisal form. Then evaluation, we also, there are two evaluation, financial analysis, qualitative analysis. On top of that, I explained to you internal credit rating module. This is very important system improvement which has happened in the recent past. All the banks now, they adapt this and then they give a rating to their customers. And these ratings can be revalidated sometimes by the supervisor. Supervisor means the regulator. So sometimes regulators wants to see how do you analyze particular industry, the financial analysis being done. And to do that, they will look at the internal rating and they want to see what parameters you have adapted to do financial analysis. How do you evaluate solvency, profitability, and so on. So sometimes you need to study the rating module much more to see whether your customer is creditworthy based on the system analysis through a credit rating module. So under evaluation, financial analysis, qualitative analysis, and internal rating methods are required. Excuse me, some disturbance. Yeah, so we were on evaluation. So I not only touched the financial analysis. Financial analysis, uh, we also, when we did this evaluation, we categorized our customers into three. You remember, um, credit scoring of retail, SME. Then we also used the four-step lending model for corporate clients, and then we looked at the financial risk of each of these. That is because we are not doing a credit program here. We are doing actually a risk management. So we are much more interested through the financial analysis. Um, what are the risks faced by your customers? So we are going to analyze the risk faced by our customers through these two analyses, one through financial analysis, one through qualitative analysis. Then we also can rate the risk of this customer by doing a system operated system of evaluation, which is called internal rating module. So these all three methods have been used to identify the risk that your customer face, and due to that risk, he may default. So credit evaluation is that. So where risk management is concerned, we are actually looking at the risk faced by the customers, which may result in default. So apart from that, once you do this appraisal form and present it to the second line of defense, that is the risk management department, they will see to which credit portfolio this particular customer goes. Now, say if you have done a tourism related customer, they will put that into the pie chart of where tourism is concerned, and they will see whether the total approved for that kind of facilities, your facility, once it is been booked, it will be within the limit approved by the board of directors. So the portfolio analysis is that. Then the capital adequacy required to give this credit also can be computed by the credit risk department and see whether this computation will not upset the total capital adequacy requirement of the bank. So if you give a facility to a customer who is very low credit rating, carrying more than carrying 100% risk weight, so you need to provide 100% capital, 14% of the risk weight you need to provide from your capital. And if your bank is, lack of capital to show in your capital adequacy ratio, that kind of a facility, granting that facility will actually affect that situation worstly. Your capital adequacy requirement will be much more than, so it will fall below 14, and then you will have to answer the regulator. So you need to check on the capital adequacy. Then also, this credit risk department have all these policies and procedures, lending guidelines with them. And when you submit your paper of appraisal, they will see you have not violated any of those guidelines given by them. Those guidelines have been approved by um, board of directors. That's why they need to actually check that. So once that is been done, they will also prepare a paper and submit back to the credit evaluation saying that risk is either high, and then they suggest to mitigate certain collateral covenants and so on. if it is moderate or risk is acceptable, they will also recommend this facility, and then it will finally go for credit approval, and then you execute the securities prescribed, security documentations prescribed, and then disburse the facility. Once disbursement is done, you just can't keep it. You need to review and do monitoring until the facility is being repaid. So this is what the credit process is. So you need to know the credit process, because sometimes the questions may come from part of it, either from financial analysis or taking from adherence to procedure and lending guidelines. So any of these circles or the boxes will be a probable question. So when you answer that, if you know the credit process well, I think I remember I asked, how do you evaluate a certain facility? Then the credit evaluation will come into scene. Likewise, the question can be set from any part of this particular slide. Therefore, I think it's a very important slide for you to study. That's about credit risk, and credit risk actually one slide which I wanted to actually show, that is that has not come in. I will check back and let you know. That is about the concentration. Remember me before we stop. I think I will get that slides. Otherwise, I will have to move quickly back to that. So we need to go to the next level of risk is operational risk. And operational risk, I find the definition is you need to understand it's a loss resulting from inadequacies or failed internal processes, people and systems, or internal or external events. So this is also important because sometimes a direct question will be there to describe operational loss. Now in operational loss, you need to understand, I had a slide when I was doing the lecture earlier, causes, categorization, and consequences. So 3 C's which I explained to you. The causes are, um, due to, that's the event, robbery, uh, or damage to a physical asset. That sort of an event is listed on one side. Then on this slide, if you have the categories, these are the 7 categories. Because risk management, you need to understand these categories very well. Because all the events of operational risk nature will be fall into these 7 categories. All internal fraud, external frauds, employment practices and workplace safety, plans, products and business practices, physical damage to assets, give me a minute. Good morning, sir. Okay. අවිනාශ දැන් ඉන්නේ කොහෙද මේ මර්දානේ සමුගස්ත ඒ සැපදුක් කෙසේද මම බැංකුවෙන් රිටයර් වුණා 2017 දී. රිටයර් වෙලා තව කම්පැනි එක වැඩ කළා මේ ෆස්ට් කැපිටල් කියලා. ඒක කොන්ට්‍රැක්ට් එක. ඊට පස්සේ ගෙදර හිටියා දැන් මේ දරුවෝ පොඩ්ඩක් ළමයිට උගන්වන්න කියන්නේ බැංකර්ස්ලට ලෙක්චර් කරනවා. වැසින් මහත්තයාට අපට සනීප මදි නේද? ඔව්. දැන් නම් මම මේ තව වැඩ කරනවා මේ මාලදිවයිනේ තියෙන කොමර්ෂල් බැංකෙන් අපේ සබ්සිඩියරි බැංක් එකක් කොමර්ෂල් බැංක් ඔෆ් මෝල්ඩිව්ස් කියලා. ඒකේ ඩිරෙක්ටර් කෙනෙක් හැටියට තියෙනවා. මාලදිවයිනේ පොඩි කරදරයක් වුණා ස්වාමීන් වහන්සේ. ඒ කියන්නේ මගේ පොඩි දුවට යුකේ හැදුණා. දාස් 20 මාර්තු වල හැදුනේ. ඉතින් මාර්ගම ඊට පස්සේ ලංකා හොස්පිටලේ ඉඳලා ගලන්ට ගාපු දොස්තර කෙනෙක් ඉස්සලා අවුරුද්දක් විතර සනීපෙලා හිටියා. ඊට පස්සේ මේ ගිය අගෝස්තුවේ ආයෙක ඇති වුණා. දැන් ඒගොල්ලෝ කියන්නේ ඒක මේ සනීප කරන්න බෑ අර බෝන් මැරෝ ට්‍රාන්ස්ප්ලාන්ට් එකක් කරන්න ඕනේ. ඒකට මෙහි කරන්නේ ඒ ඔපරේෂන් එක ටිකක් විතර කරලා තියෙනවා මෙයාගේ මේ ටයිප් එකේ. සාර්ථකත්වය ගැන ඒගොල්ලෝ විතර වගේ දෙන්නේ. දැන් වෙලා තියෙනවා සිංගප්පූර් වල එක කරන්න. මොකද යාවෙත් දවස්වල ඉස්සරට එන්න අය බාර ගන්න උගක් ස්පිතාලවල. ඉතින් අපි දැන් දුව කරලා තියෙන්නේ හෙට. ඒක සුමාන වගේ යන්නේ. අපි ඉස්සෙල්ලාම මෙහි ආණ්ඩුවේ ස්පිතාලේ තිබුණා මේ නැෂනල් යුනිවර්සිටි හොස්පිටල් කියලා සිංගප්පූරුවේ. ඒකේ තමයි ඉස්සෙල්ලාම කන්සල්ටන්සි කරේ. ඒකෙත් මේ රෙස්ට්‍රික්ෂන් එක ආවා මේ කොවිඩ් හින්දා. ෆොරින් පේෂන්ට්ස්ලා ගන්න නැති වෙන පොලිසි එකක් දාලා. ඊට පස්සේ දැන් ඒගොල්ලෝ රිෆර් කළා ඒකේ මොකද ස්පිතාලේ තියෙන මම පිළිසිඳ මල දැන් ඒකට තමයි රිෆර් කරලා තියෙන්නේ. දැන් විතර කන්සල්ටන්සි කරලා මේ සුමාන ගියේ. ඒගොල්ලෝ ටෙස්ට් එක ඔක්කොම අරගෙන මේ දැන් තමයි මේ ට්‍රීට්මන්ට් ප්ලෑන් එක කියන්නේ. ඒ ට්‍රීට්මන්ට් ප්ලෑන් එක ගාව මම ඒගොල්ලෝ යන්නේ මේ ඔපරේෂන් එක වෙලා තියෙන්නේ. ඔපරේෂන් එක කරලා ස්පිතාලේ ඉන්න ඕන අඩුම මාසයක් විතර මේ ආයේ මැරෙකින් අපේ පොදුදාම හැදෙනක ඊට පස්සෙත් අනිත් කෑවට මාස දෙකක් විතර ඉන්න ඕනේ. ඉතින් මාස 3ක් විතර ප්‍රමාණයක් සිංගප්පූරේ හැදෙන්න වෙනවා. ඒස් වැඩක් නෙවෙයි. ඒක යනවා. ඉතින් ඒ මේ ටිකේ එකට එන්න මෙහෙට මොනවා මට ලයිස්ට් එක ගන්න විලාසුනේ. ඉතින් වෙලාවක ලැබුණොත් බලන්න එන්නකෝ කෝල් එකක් දීලා. ඔව් ඔව් ඔව්. හොඳයි නම මම කියන්නම් මම වෙලාවක කෝල් එකක් දීලා ඉතින් බලලා එන්නම්. හොඳයි කොහොමද කතා කරන්නේ? Right, I'm sorry, that call I had to take. It is from one of the Nayaka Swami Nuances, so happened to be a client of mine long time ago, and he has remembered my number and call, so I had to oblige clergy, so you have to respect him. Right, so we were talking about operational risk. Operational risk, this importance of these categories. I was telling internal fraud, external fraud, employment practices and workplace safety, clients, products and business practices, physical damage to assets, business disruption, execution, delivery, and process. Now, they might give you a kind of an event and request you to put into one of those categories. Now, say we'll take for example, cash shortage is a key operational risk indicator in your operation risk. What category it belongs to? It belongs to the execution, no? So you are actually doing your job, and while doing that, you make error, and then uh, when you execute and you do errors, that will fall into execution and delivery process management. So category of that is that. So different. Now say uh, your cash in transit has been robbed by outside robbers, will go to external fraud, or um, it is not due to error. It is someone's fraudulent activity or criminal activity which has caused that loss. Okay, we'll say one of your employees um, has filed action against your bank. It's a kind of a legal risk due to uh, management treating him or her bad. So he has gone to the labor tribunal and filed action. Then it goes to employment practices and workplace safety. Similarly, your computers in your main system was damaged due to lightning or whatever reason. Then it's a physical damage to your assets under number 5. So you need to actually collate your incident of operational risk into these categories, and remember these 5 categories well, so that you can actually really identify where it has gone wrong, and as a result what it belongs to. Then operation risk, we also looked at, the measuring operation risk is sometimes, not like you cannot put figures into that. Until operational loss occurred, you don't know what extent of damage it has caused to the bank. So one of the method we use in our operational risk identification, measurement, and response, we use something called impact and probability graph. So that means we put our events into a graph like this. In one axis, we have the impact, the other one, we have the frequency uh, or the likelihood, how often it happened. Impact is the severity. So severity, you can put minor, moderate, high, or very high. Similarly, the likelihood or frequency, you can put remote, unlikely, possible, likely, frequent. Now, cash shortage is a minor impact, and it will fall into the frequent category because you have branch network. Quite often this happens. So what you do to avoid situation of that nature, because impact is low, but what you do is you do certain internal controls. You are not going to do anything else. Uh, that's a mitigation technique we follow. Just imagine you have a robbery of your cash in transit. Uh, it's a catastrophic event or very high impact event. Lot of money being involved, and generally it won't happen very regularly. It's a remote incident, so it will come on top of this axis, close to the impact line, and there we have put a share. The risk need to be shared. How do you share? Or we generally we call it, we don't share risk, we transfer the risk. So how do we transfer is we take an insurance against that particular type of event. And then when that happens, we do a claim and get our money. So this particular graph also important to see the impact and probability. But apart from that, we also use other methods of um, measuring operation risk. I also told risk control and self-assessment exercise, where you send a paper to each department of your bank and ask what areas, or describe the 3 or 4 risk events which is going to happen in your department or unit, and then what mitigation actions you have taken. So we collect those information and keep in our uh, knowledge bank, and then we also looked at loss data in the past. What are the incidents which has happened, which has created operation losses? Then there is another thing called near misses. That means you have done a mistake, but no financial loss occurred. You have corrected subsequently, and those are kind of a lessons learned without having to incur a loss. So those also very important, along with risk control and self-assessment process, then loss data collection process, near misses collection data process, plus putting those incidents into a graph and see the impact and the likelihood for you to determine the uh, action you need to take, either to strengthen the internal controls or transfer the risk by taking paying a premium and taking insurance cover. So that's how operation risk are mitigated. Generally, banks' internal controls are done, examined by the auditors on a frequent basis to make sure that operation risks are minimum. So that's about operational risk. And then another important area is the market risk. Now, market risk is, I told you about in answering that question earlier. I said it's about price. So volatility of prices will result in market risk, interest rate, foreign exchange, equity, commodity. We put some figures and did some questions for your better understanding. So you need to actually identify these four categories are involved in managing market risk. So thereafter, once you identify these categories, then you can put certain examples of giving figures and do the calculation of losses arising out of this. Then those losses will actually directly affect your profitability of the bank, and that's why we call them market risk. Now we tried equity risk, we tried commodity risk. Interest rate comes from I told you that if you have assets and liabilities, if they're matching under each bucket of duration, then you don't have liquidity risk. But in case uh, if you don't have match, then you will have liquidity risk for which you need to manage liquidity. We will talk about that. And then these assets and liabilities have different interest rates. Some are on floating, some are on fixed rate. But in the market, interest rate could fluctuate. So your fixed term loans, just because the interest rate goes up, sometimes you may not be able to change unless otherwise you have kept provision in your offer letter that if market rates moves up, bank has the right to revise the interest rates. If not, you may need to charge them. Like we say, for example, I take a lease. You give a lease for 6 years. We say at 10%. At that time, the policy rate may be about 8%. So you have a markup of about 2%. But current inflation is moving up. Supposing if they put the policy rate to 10%, what will happen? You can lend, then at that time you can lend something like 14, 15% very easily. But you have lent to this particular lease facility at 12, and it will continue for next 5 years at the same rate. Whereas you have now opportunity to lend at higher rate. So the opportunity cost of doing that earlier business is due to interest rate fluctuation. So those things also you need to identify. Um, that's the market risk. Then we go little further on the same subject. What we do in each managing each stage is kind of a testing we do, and those testing is done based on various techniques. Now, I will take interest rate risk. Um, you have you have a government securities investment which carry interest rate. Then also you have interest-bearing assets on your loan book. Now, if the interest goes up and down, the results will be maybe different. So, in take for instance, you have a in trading portfolio. Say you have 100 million um, investment there, and this investment carries an interest rate of say 6.5%, right? So that was the rate applicable at the time when you made the investment. That was the base policy rate. Now, if the government thinks in order to encourage credit facilities, they need to reduce the interest rate. That's what they did when the time the COVID was affected the country. They thought we might pump more money into the market at a lower rate, so the people will actually try and survive in their businesses uh, to keep the economy going. Then when the rate comes down, now what? Just see what will happen to the market rate. You can invest um, the same amount, but you will get lesser value in way of interest rate. Now, since you are holding an instrument which carries a higher rate than market rate. Now, say making mark to market is the process to see whether you can make a quick gain out of the situation. Now, say when the interest rates goes down, you are having instrument which carry a high interest rate, which you can sell at a rate either in that instrument and get money, and then invest the original portion on the same value and mark that you can have that profit into your profit and loss. This we actually did once, and in one of the test papers, not the one we discussed earlier, the previous one. So marking to market is give you either a loss if the interest rate goes up and you are having lower rate interest rate bearing instruments, which you have to mark into market and then sell it, then you will make a loss. But if the interest rate goes down and you are having instruments which carry high interest rate and then trying to sell that product, you will get a higher rate than what is prevalence in the market. Therefore, you make a profit. So these are the things where interest rate is concerned. Equity, mark into market is mark to market is you will actually see what is your portfolio value. So, say if you have invest in Dialogue when it was 11 rupees, and after 2 months you go and see the stock market prices, and if the price is 10, that means your value of your shares have come down by 1 rupee, and 1 rupee into your total investment on that particular share will be your loss position, and that loss position will have to debit to your P&L. Similarly, you can mark to market and have profit and adjust it to your P&L. Now, commodity risk, once again, it is the same thing. The price factor, your investment rate, the price what you paid at the time of investment, and time of price at the time of you are trying to sell. Difference can be either a profit or loss. Exchange rate, we looked at your short open position. If you have a short open position and if the rupee get depreciate, you will have losses. So those are the techniques, some of the techniques what we to do to evaluate things have been listed here, but mostly I'm not trying those techniques. What I will do a simple computation of risk by way of loss or profit by way of doing market risk management in interest rate, equity and commodity and exchange rates. So that's what the exchange rate is about. Then you remember we covered another question in the morning. We also said that what are the features of Basel III? Enhance quantum and quality of capital to increase the leverage, then also to set global liquidity standard by way of liquidity coverage ratio and net stable funding ratio, which will allow additional support for the financial system, so the financial system can be happy that if the players like banks have their sufficient capital in the form of quality capital, and also they have a very good liquid coverage ratio more than 100%, net stable funding ratio more than 100%. These are actually global standards, and if we are going to maintain those global standards of risk management, definitely our banks are going to manage risk well, because apart from the regulators guidance, we also adhere to the global standards. So Basel III may a possible question. So those are the things which I found um, I may include. But apart from that, I may need to bring in some more shares, slides, some more slides to for right. So we will. IT risk, information technology risk also important. I believe at the current context, mainly due to I think earlier question we have different delivery channels taken prominence over traditional delivery channels. That means we follow internet banking, phone banking. We use our ATMs very extensively um, to do the delivery of our products. So managing IT risk is also has come as one of the major risk factor for banks, because of now they are open 24 hours. I told you they need to have their systems open 364 days. Not like those days you close branches at 1:30. Thereafter, customers cannot access any information or any data out of the bank, so you're safe. So the systems, you need to have foolproof systems in order to manage information risk. That means you need to have up-to-date system along with certain precautionary measures you take in your data center. So it's the systemic approach of ascertaining impact or likelihood of information asset being exposed to threat. This is the official definition what you give. But I also said there are two types of IT risk coming from information risk. That means, yeah, your hardware, what you use, your software, what you use, your database, what you use, could get damaged due to various execution, wrong execution, allowing unauthorized people to mingle with those data. internal frauds. So those operational categories also will get involved in resulting in information risk. Cyber security is that it's kind of a external fraud where outsider who get into your data, and we may have different methods of um, mitigating in this insecurity what we have in our systems. So we need to have a lot of techniques to mitigate information risks. And try to go through those, right. This slide is important. Data center security. So you need to provide maximum security to your computer department or where the mainframe is there. Only the authorized persons with a card or fingerprint access should allow to enter. Then security of assets like computers, servers, networks. You need to train your staff to how to use them. Then you need to take support from your service provider, like if it is the IBM or whatever, NCR or whatever. You need to actually get their support to get this machine regularly service, uh, check their functionality. So you set up service agreements. Then on top of that, you have this antivirus software, spyware, firewall protection. Finally, once you all do that, still not enough. You will need to, because if something happens, the damage is enormous. Therefore, you need to actually transfer those risks by way of insurance. Then security of data, will be done through password protection. We have, encryption of sensitive data, we don't even allow our users to look at. We will encrypt them in a way that they only can view it. They can't do any administrative work with those data. And data backup and firewalls also a kind of security of data protection. Frauds. You also need to, educate your customers and introduce fraud detection systems. In the bank itself, also you need to have segregation of duties. This is a very important control measure where, even in manual writing of a voucher, you have a person who's preparing and person who's authorizing it, signing at two different places to give us authentication of the original voucher. And then you need to have password controls, internal and email security also, I discussed earlier. So this slide is also very important because this talk about um, how do you mitigate or how do you manage information risk through various systems. You have to provide data center security. And you have to have a disaster recovery plan and another computer in the disaster recovery center, another mainframe where something happens to the data center that they can go up and running from the disaster center. Then security of assets, this could happen from lightning, fire, and all that. So you need to make sure that you have insured them so that you can replace them immediately. Otherwise, it will be difficult for you to provide service to your customers. Security of data is, password protection is a must. Also, you need to back up and hold it somewhere else for protection. To have firewalls to various systems so that fraudsters cannot get in or hackers can't penetrate. Frauds could happen due to customers' ignorance, where you don't have system. One of the fraud detection system is you can check how many attempts have been made to penetrate your firewall to access data. Then the vulnerability of that. one day they will find a system. Your current firewalls have been used to dispel all those attacks. But what will happen if a hacker will come to know that this is the firewall you are using? As a result, we can penetrate. He comes with a different proposition, a much more penetrative system to get your data. So you need to be updated with that system. These are some of the things which you need to know about information security. Another area of importance is liquidity. Uh, like credit market and liquidities are all three independent risk factors which may bring down a bank. So managing liquidity is very important. That's why the Basel III committee also have given you certain measures to manage your liquidity by way of liquidity cover ratio and net stable funding ratio. Regulator also worried about the liquidity of the bank. That's why they have this um, statutory limits called liquid asset ratio. Um, so these are important area. So you need to know what is liquidity and yeah, its ability of finance to ensure sufficient funds are available to meet its contractual or relationship obligation, such as loan demand or deposit withdrawal. You know, uh, your credit department will approve. You cannot uh, hold on to disbursement once it is approved. So there will be a demand for your loan. At the same time, government directives will come. You lend to these sectors, so those demands will come, for which you need money, and the money need to be taken from your depositors. And depositors also have a right to withdraw. And when that withdrawal comes, you cannot have a liquidity problem. So you may be able to fund back those amounts which are outgoing through incoming cash flows. Incoming cash flows can come from repayment of loans and accepting new deposits, accepting certain investment instruments on like debentures, or money can come from right issue of to existing shareholders. So the money can come that way. Apart from that, you can have interbank borrowing. So you can either go borrow from another bank, or you can go to central bank and also borrow money to meet liquidity requirements. But those borrowed money also need to be paid. Yeah, to remember at a at interest and the price. So you need to create more deposits into your bank to have liquidity gaps maintained. So financial system, they say, runs on confidence, and when confidence erodes, it erodes quickly. That means if you fail to sufficiently fund, you don't have sufficient funds to make your obligations, like loans on demand, deposit withdrawals. Your confidence level also will lose. When that loses, there will be a run on the bank, and you can close the doors very soon. Um, so remember, I just told liquidity can be stored by way of cash reserved with central bank, treasury bills, and bonds. You don't keep all in cash because you need to make money out of that by way of loans and advances. You also can purchase liquidity through interbank borrowing and through repos. This investment uh, you made by way of bonds and bills you can have repurchase agreements back again from central bank, placing those bonds and create money uh, to manage your liquidity risk. Similarly, debentures can be useful. Uh, the funding can come from that your own sources as well as interbank borrowing and other places. But if the in the market funds are scared and other banks also not lending, then you will have a market liquidity risk because you may not be able to borrow money from elsewhere. Uh, and when that happens, uh, position is not very smooth. You may have to actually mobilize deposit at high rate of interest, and then your profitability will get affected. So some of the indicators what they follow in banks is they actually assess the statutory liquid ratio in local currency and also in foreign currency. Now, foreign currency is the problem now because deposits are not coming and they may not be able to maintain certain statutory requirement of liquidity. Then we also can use something called advanced to deposit ratio. We call it ADR to measure the liquidity. Then liquidity can be pumped up by borrowing through swaps. If you have arrangement with foreign banks, you bring in dollars and then you place that dollars in central bank for a short period, 3 months or 6 months, and then borrow rupees from them to that equivalent. And at the end of 3 months, you pay the rupee what you have borrowed to central bank and request the dollars what you deposited with them through the loan what you got from foreign bank. And then when you get that dollars, you can send it back to the foreign bank in dollar form without having to incur any exchange loss. So swaps also need to monitor, and central bank generally give a limit to do that. Then you can either see external borrowing from other institutions. Sometimes there will be limits on these by the regulator. So these are some of the two ratios of the Basel II liquid coverage ratio. I have given some in this slide. Stock of high quality liquid assets divided by total net cash outflow over next 30 calendar days. The result should be more than 100%. And what does this liquid asset ratio gives us sufficient level of unencumbered high quality liquid assets can be converted into cash to meet its liquidity. So when you say stock of high quality, we tend to maintain the required high quality liquid assets by way of cash, easily convertible bonds and bills. These are kind of high quality stock of liquid assets. So this give a idea. Then also next one is net stable funding ratio. Here what you need is instead of available, you need to put as required the First is available amount of stable funding divided by required amount of uh, stable funding. So you need to change that uh, in the slide, and that also need to be over 100%. So Basel III also specify what are the what you call the high level of liquid assets, cash, sovereign and central bank bonds. Level 2 is sovereign and central bank debt, cash outflows, retail deposits, unsecured wholesale deposits. So um, any outflows also you compute and then arrive at the liquidity coverage ratio based on the guidelines given here by the Basel Committee. So that's liquidity risk management. We may have to touch I lost the connection while trying to change the slides. So we'll see. I'm also sharing some slides on compliance risk because there could be a question on them. Because compliance risk is also important. It's a major risk. Let me see what the importance. This is also a very important slide where, under current context, central bank wants to, have due protection to your customers because banks like to make money and, sometimes we get ignorant customers who doesn't know the procedures. They get into certain contracts not to their advantage, but mainly to the advantage of the bank. As a result, they suffer losses. To protect them, something called customer charter has been introduced. So customers' right to receive information and understand financial products and services is mentioned here. That means if you need to explain the benefits, not only the benefits, um, any shortcomings, if any of those products go the other way, whether he will have losses. Like, asking your customers to invest in certain thing and that advice goes wrong, not having explained the consequences, then bank is at fault. Therefore, this charter says bank to have a code of conduct. That means all employees must follow similar rules. Right to receive information is your customer's right. Awareness or understanding, terms and conditions. Now, say in most of our products, this is subject to terms and conditions, and we put this in very smallest letters where customer can't read. So even in this, especially electronic products, you put a small version say subject to terms and conditions, or They will say these are the terms and conditions and ask you to agree on them. And I'm sure most of us, without reading the whole thing, they will click the agree button. So those things are need to be covered under customer chart. Um, we cannot appoint agents who will harass our customers. So protection from agents also we need to be compliant. Any complaints about anyone in the bank will be made through complaint system so that we could avoid reputation risk. Special attention to elderly. Now, actually, most of the banks have this, wheelchairs can be brought into the banking premises. So those are necessary to provide, according to this customer charter. Um, these things also, why I listed was, um, those are compliances by now banks will have to adhere to, but not only apart from, certain, compliances like minimum capital requirement, liquid asset ratio, then your lending to your related parties, directors, how you should follow, and also what securities you should take when it is given, uh, then your single borrow limit, whether you adhere to those. Those are regulatory requirements which you need to adhere, not to get subject to compliance risk. So I will go into another risk category. So our last item for today will be the corporate governance. Now, we have been talking about can someone say whether you can see the slide?
Okay, sir.
So under corporate governance, what we are going to discuss is actually separation of ownership of control. That means we want your chairman and the CEO to play two roles. Chairman is the chairman of the board of directors, and the CEO is the boss who runs the bank on behalf of the board of directors, but he deals with entire staff and the customers, whereas board doesn't involve in that. So we need to have these two separation going because one management and the other one is oversight function has to perform separately so that the disclosures will be uh, done without any impartial disclosures. Then transparency can be maximized. Uh, where central bank is concerned, the directors will not play a role under management and take advantage of their own companies. Related party rules will apply on them. So those things are governed by thing called corporate governance. And what is important here is uh, you need to understand the responsibilities. They are accountable for risk management. They need to identify the risk appetite. They need to delegate to CEO to conduct business according to the policies what they have approved. They should understand the banking risk, also civil and criminal liabilities, and manage the affairs of the bank, the structures, disclosure of information, and delegated authority, all that they need to manage, and then make sure that your bank is safe and sound. So these are the responsibilities. The important is to identify the responsibilities, and the composition is also the other area which you need to have attention, which will include mix of executive directors, non-executive directors, and independent directors. They must have different skills and experiences, different qualification to manage the bank affairs. Accountants, lawyers, bankers, all must get involved in the board, and they must meet at least once a month. And director's age should not exceed 70 years. So these are some of the board compositions which you need to, understand. Finally, under corporate, what the main responsibility is to actually disclosure of affairs of the bank in a very transparent manner. Accountability and transparency has to be um, exhibited to the maximum, and according to the required law, and also to encourage investors to remain with you. So disclosure is also very important. So with that, I think I have covered the revisions also. So the questions will be based on those. If you have any more doubts, you can clear now, because you'll have a few minutes to deal with some questions and doubts. You can even put on chat box where I can answer. We have covered 2 past papers. I think that give you immense knowledge. You know how to tackle the exam. I explained to you the individual assignment in detail for you to do that and be a precursor for your exam. So I also recommended you to write some answers to the 2 past papers we have already discussed based on the notes what we have done during my explanation. So with that, I think we are ready. Still you have any doubts? Now you can clear. So Shalini Ratnaik has one. What will be assignment submission deadline? It's a common question. 28th of February. Okay, answer is given. So anything other than that, something relating to the subject? Okay, you are welcome. Can I ask you a question to get a fair answer? Are you ready for the final exam? Oh, great. I also got a comment of the thank you, paying gratitude for my kindness of teaching. It is not the kindness, actually, I put into I stepped into your shoes and see whether how I can make you understand this subject well, because sometimes the risk management is considered kind of an alien subject for many of them, because most of them are involved in business areas, and when you talk about risk management, it's a back office function, and practically most of you all are not doing it, therefore you find it difficult to understand. So So I went to the extent of, I'm also a business banker like you for long years in operation credit, various areas. Finally, there was an opportunity in this particular area, which at that time I didn't know anything about it, but I took the challenge to learn, and that has helped me to, do this subject for you in this postgraduate diploma. And I hope you understand the subject well, and wish you all the best for your exam. And I wish to see good results. Right. Then I will conclude. Once again, good luck.